U.S. banks subsequently see upturn in credit card borrowing. New York big U.S. banks such as J.P. Morgan Chase & Company (NYSE), JPM, and Citigroup (NYSE) seem set for a few income raise from a pickup in the battered credit card enterprise. However, a likely recession might pull customers back and bring losses on super loans. Last week, J.P. Morgan chairman and CEO Jamie Dimon warned of growing recession risks and braced buyers for a probable hurricane. In constant financial instances, cards are one of the most worthwhile agencies for banks, and analysts say a persisted upturn in card borrowing would carry comfort for banks. When purchaser spending crashed in the course of the pandemic, Citigroup marked a low factor as 2020 ended with a 13% fall in quarterly sales from U.S. Citi-branded cards from a year in advance. Now normal balances on credit card and comparable loans at U.S. banks are up 15%, as of May 25, from a year earlier, and back close to pre-pandemic ranges, in line with Federal Reserve records. Even better for banks, cardholders now are allowing more of these balances to revolve and incur hobby prices in place of paying them off month to month. While the scale of revolving balances is not often disclosed through banks, it's miles critical due to the fact hobby from revolving bills brings in a whole lot more sales than transaction prices from traders. Some of that are shared with card networks, including Visa (NYSE), V, and MasterCard (NYSE), MA. The most worthwhile a part of the credit scorecard commercial enterprise is the patron revolving balances, after which paying them back through the years, said analyst Jason Goldberg of Barclays, Lon, BARC. At J.P. Morgan, revolving balances are up 8% from the low, Marianne Lake, co-chief of its Chase client bank, told an investor convention in May. During pandemic lockdowns, purchasers reduced credit scorecard spending and paid down balances like by no means earlier than way to stimulus bills and cash from refinancing mortgages. The share of active card bills with revolving balances proportion has accelerated for the past 2 quarters to 52.6% after plunging to 51.3% inside the pandemic. Those balances normally prevailed at around 60% stage for the 7 years earlier than COVID-19, after being as excessive as 70% during the 2008 economic crisis, in keeping with records from the American Bankers Association. Popular myth: banks say cardholders are paying off their debts a little extra slowly now, ensuing in better interest-bearing balances. Discover Financial Services (NYSE), DFS, as an instance, stated fees had been still substantially better than earlier than the pandemic, however had leveled off or even eased barely within the first quarter. As lockdowns got off, banks closing year stepped up card advertising and eased credit score standards they had tightened in advance in the pandemic. Credit playing cards issued quarterly jumped 39% in the fourth quarter of 2021 from a year earlier to 21.5 million, the highest on file and 14% better than earlier than the pandemic, in keeping with credit score reporting organization TransUnion (NYSE). True. Chase, the largest issuer of cards within the United States, has discovered evidence to quash a few investor subject that consumers had sworn off credit scorecards, JPMorgan's Lake stated. Younger generations, Lake said, opposite to popular myth, aren't averse to credit or credit cards. Members of the Millennial and Gen Z generations amongst Chase clients placed 60% in their spending on credit playing cards. And they are borrowing more as they age, she stated. Now a few traders worry the banks gets too much of an excellent factor with the aid of having promoted credit score playing cards simply as the threat of recession rises with tightening Federal Reserve policy. The banks say they learned from the economic crisis that understanding whom to lend how tons is greater important to profits than trying to assume recessions. While card delinquency prices have risen the past 3 quarters, they're still under pre-pandemic tiers, consistent with TransUnion records. Charge-offs fees for awful credit score card loans at banks turned up within the first sector to 1.82% from 1.57%, in step with Federal Reserve information. That's half of what they were earlier than the pandemic and low sufficient for banks to make money. For now, unemployment, a huge motive force of losses on credit cards, is low and wages are rising, noted Barclays' Goldberg. In the near term, Goldberg said, it'd have to be a fairly worthwhile business. But banks have to consider of the following monetary downturn.